Hi, everybody, and happy Monday. Today, I'm going to present a couple of charts for my chart of the week, and the subject is venture debt. Now, I think a lot of people are looking at the venture market and they're seeing what we're seeing in the chart here, that venture capital is drying it up. And although I've said in prior posts that although the venture capital market has been slower than it has been in the last 2 years, this chart continues to tell a story that it really has just gone back down to 2019, 2020 levels, which themselves are way higher than levels from 10 years ago. There's still a lot of venture capital out there, but there's no denying that there's a lot less out there than there has been in the last couple of years or so. And you'll note that this chart only presents data until the third quarter of 2023. And I think that once the data comes out for the fourth quarter and then first quarter of this year, I think we're going to find that venture capital has dried up even further, which means that companies that are looking to bridge their way from wherever it is they are now until cash flow positive and profitability, they are looking for other ways to finance their businesses, which we would expect. And one of the areas that I think a lot of entrepreneurs and founders are interested in learning about is the venture lending area. Now, the venture lending area, I think, is often misunderstood. And this chart, I think, will help clarify it. And it's misunderstood in the following way. Venture lending is not a source of capital that steps in when the equity markets dry up. Venture lending tends to follow the equity market. So lenders tend to want to lend money after there's already a lot of equity being put in. In a lot of ways, they rely on the venture capitalists to do the due diligence and to provide that stamp of approval that the loan is going to be a good one and is going to be a relatively safe one for the lender. What venture lenders are reluctant to do is to come in and take the place of venture capital, because that's simply a different risk profile than most lenders are willing to, frankly, get comfortable with. And I say this not because I want to be a downer, but rather I think it's important to be realistic in this environment in terms of where you can go to get funding for your venture. And if you have access to venture lending, great, pursue it if you think that it's right for you. But what I don't want is for founders to go out into the market, kind of get the door slammed in their face in the venture capital side and think, oh, okay, well, I'll just go get venture lending. That's not how it works. And you can see in this chart here that venture lending has pretty much followed the venture capital equity markets in terms of availability of funding and the number of deals funded. So what do you do if venture lending isn't really a good option for you? Well, if you do have an offer for venture debt, realize that you probably are one of the lucky ones. You don't have a lot of leverage, right? You're one of the ones that is potentially getting a chair when the music stops. Now, this is not saying that you should just take venture debt no matter what. I don't know your situation. I don't know what your other alternatives are. But certainly if you think that it's right for you, I wouldn't necessarily risk that deal trying to squeeze the absolute best terms and conditions out of the deal. Don't spend too much time going after venture debt. Explore it, see if it's right for you, see if you get some nibbles. And if you do, go ahead and pursue it. But understand this is a contracting market right now. There's a lot more demand for venture debt than there is venture debt capital available. If you're finding a lot of resistance to your deal, it may be time to think about other things, because as a founder of a startup, particularly one with a limited runway, you can't afford to waste your time on avenues of financing that just are low likelihood outcomes, right? You need to go for things that are more likely than not to result in funding the business. So instead, go all in on getting revenue. You've heard it before. This is not news to anybody watching this video, I don't think, but it bears repeating. The best way to finance your company is through customer revenue. And just because perhaps until this point you've been funding your company without that revenue because the capital was available, this is simply a moment of truth. And what's happening is you are at some point going to have to find revenue for your company. At some point, you're going to have to generate sales. All that's happened is you're going to have to do it a little bit faster, a little bit earlier than you probably wanted to, right? So take a deep breath. If you've got a product or a service to sell, go ahead and sell it. Don't wait until it's perfect. Nothing's perfect. Microsoft Windows has never been perfect. Mac OS has never been perfect. And they've got billions upon billions of dollars at their disposal, right? Get it out there. Whatever resources you can scrape together to push sales and demand development, now is the time to do it. At the same time, there are other alternative sources of financing to consider. For example, there's a source of financing called revenue financing. It's kind of like a royalty, but without intellectual property. You'll agree to pay a certain amount of revenue off the top to lenders to your company. Another potential source of financing might be purchase order financing. Get a big deal, get the sales. And if you don't have the working capital to actually implement the deal, find the purchase order financing that will give you the working capital to secure that revenue coming in. Not on the screen here is a source that is often overlooked, which is grant financing. Grant financing is more available than you probably think. Grant financing is a fact of life for emerging biotech technology pharma companies, because they need 10 years and $100 million at least to go from molecule to market, sometimes $1 billion. The private markets can't absorb that much, so they get a lot of money from the federal government, university grants, and other foundations. That may be the case for your company as well, particularly if you are in a social industry, or if you're in an environmental sustainability. That option may be available to you as well. And then finally, see if you can convince your employees to accept equity rather than cash compensation. Now's a good time for equity holders to buy. Now's a good time to receive stock options because the prices are low. So the upside potentially is going to be higher. Given that for most companies, labor is the most expensive cash outlay. If you can take away that cash outlay, turn it into equity, stock options, phantom stock, something of that nature, and redeploy that cash into sales, that may just be the thing that you need to survive this difficult financing time. We have certain disclaimers. If you need to read them, just pause and read them through. I'm not going to use my time and your valuable time in this video to go through them. And thank you very much for watching. If you want to learn more about the kinds of things that we do, the kinds of things that we talk about, please subscribe to our newsletters at the link below. And I'm curious, what do you think about venture financing? What do you think about venture debt? Are you finding that available? Is it not available? If you're finding it available, what is the interest rate? What are the terms? Let's get a conversation going and educate everybody. Thanks again for watching, and have a great week.